Tune into episode 86. We're going to talk about the big, beautiful bill and why it may not be that beautiful.
You're listening to Between Two Bridges, a business-to-business podcast. With your hosts, Joe Ferranti and Jerry Kenna. Produced by Nathan Kenna. Interviewing entrepreneurs, business operators, and investors. This episode is brought to you by Wash, because laundry shouldn't cost your time. Wash delivers. Sign up at pickupwashdeliver.com. Do the wash. Skip the hassle.
All right, we got episode 86, Between Two Bridges. We're gonna dive in a little bit. They're coming up, obviously new regime, I guess you could call it.
Well, we got the big, beautiful bill, or the big, maybe not so beautiful bill.
Yeah, I mean, we're
gonna tear it apart tonight.
Yeah, we touched base on it when they talked about it, but now it's starting to get some teeth, right?
Yeah, so I actually spent some. I had to go to a tax seminar, so I'm an enrolled agent.
Oh, that's one of those perks of being an accountant, right?
No, it's not a perk. It's this sucks big time. But because I'm an enrolled agent, I'm required to take 24 hours of continuing education every year, and I spent 8 hours learning about taxes the other day.
So we're going to whittle that 8 hours into like 44 minutes for you guys.
Yeah, maybe. We'll see how long this lasts. But I'm going to try to make this as interesting as possible. Trust me, you're going to want to hear this. So I'm going to try to, there's some things like we talked about the big, beautiful bill a couple weeks ago. And some of the stuff I was reading, I was actually kind of excited about. And there's some of the things that are pretty good. But we dug way deeper into it yesterday. Now, as of the recording of this is still, it passed the House. It did not pass the Senate yet. The Senate has put together a proposal. We're going to talk about some of the things that the Senate has presented that are a little bit different so far. We'll talk about that tonight too, but nothing has passed the Senate yet. I do feel like some iteration of this is going to pass. Probably sometime this month, being July. I don't know what, if anything, that we talk about in this episode is going to stick, what's going to change. But I want everybody, because there's a lot of bullshit out in the media right now, depending on what channel you listen to, depending on what side of the fence you are. And what I'm going to share with you right now is not partisan, it's not biased, it's just the facts that are laid out in the bill. This is just, this is part of the instruction that I have to go through. When I have to learn about this stuff, it's not, I don't get the luxury of just learning about the good parts.
Yeah, you got to learn.
I have to learn about all the parts.
I like how you disclosed, like, we shoot this a week in advance. And there's been times, like, when I leave here and I start thinking, like, this podcast is going to air and our country is going to be in a World War III.
Yeah, and there's a possibility. Yeah, and we kind of joked about this before we started recording this, that there's a possibility that we may never air this episode. So if you're listening to this episode right now, this is still relevant information. There's a very good possibility that we're going to record this and then have to do another episode to record.
We live in very fluid times.
Very fluid times, where this may end up not being relevant by the time this actually is to air. And this is all for nothing. But we're going to go through it anyway, because we're living in such a fluid time that we have to do it. We have to run with it. We're rolling with the punches here. We're going to tell you the way things are as of today, because that's the best information that we have. And hopefully by the time this airs, it's still the best information that we have. If it's not, you're not watching this. So, and
it'll be like episode 1. 1 and 86 will be the same.
Yeah. So just, bear in mind that as of the day that this airs, that's the information that is the most current. But if you're watching this, I believe this is going to air like the 2nd of July.
7/2.
If you're watching this in September, that doesn't necessarily mean that it's relevant information anymore. You need to tune in to further episodes down the line because we're going to keep doing updates as this evolves. But as of July 2nd, if this airs, it's the most current information.
Yeah. So we tax and tips, or are we not tax and tips?
This isn't necessarily tax and tips. This is just the actual truth about the big, beautiful bill, some of the headlines, some of what it actually entails, what you can expect when you do your taxes this year. One of the challenges that I have this year that's different from all the other years. This year was my 18th tax season. So I'm a seasoned professional at this point. Every year I try to sit down with my clients and, a lot of my clients, we do taxes, everything's the same. We get the tax return done, we get it out, it's in and out, no big deal. Some of my clients, they're planners. What's next year going to look like? My kids are getting older, I may not be able to claim them next year, or I'm going to make more money, or what's going to happen. And they want to plan. They want to,
I envy those people.
They want to make decisions. What can I do to save money? Blah, blah, blah. And this year posed a challenge because the Tax Cuts and Jobs Act that was enacted at the end of 2017 that went into effect in 2018 is set to expire as of 12/31/2025, so the end of this year. Now, that means that at the end, that for tax year 2025, so whenever you file your tax return in 2026, your tax return is going to look just like it did since 2018. Theoretically, we'll go into that. However, in 2026, things are going to change. And if they don't pass something, it's going to revert back to pre-Tax Cuts and Jobs Act, which is the 2017 taxes, which is going to go back to before the standard deduction was doubled. It's going to go back to personal exemptions. It's going to go back to many people itemizing on their tax returns. It's going to go back to much higher tax rates. There's a lot that's going to change, which
you'll be dealing with a lot of people that are upset.
A lot of people are going to be upset. The vast majority of people, taxes are going to go up. The other challenge as a tax preparer is obviously I haven't looked at that tax code since 2017. So we've all got to kind of relearn that tax code. So that's going to be a challenge. So as politicians are going to look at this and they are on a clock. They have to pass something because if they want to be reelected, they need to do something here because whoever is going to be running against them during the next election, if they don't pass something, is going to use it against them that they are the reason why your taxes went up. They are the reason why nothing got extended. And they're on the clock here. This is big. Right. So they have to do something.
They have to do their job.
They have to do their job. But this poses a problem for me because I can't really tell you what 2026 looks like because no human on earth knows.
Right.
Not even the politicians, because they can't make a decision right now because they're all still arguing about it. Now, the House of Representatives passed the big, beautiful bill. I think it got passed by like 2 votes. So it's still highly contested. The big reason why it only passed by 2 votes is because Democrats think that the tax cuts are too great. Republicans that voted against it think that it is not, that it's too much as far as it didn't do enough to cut budget spending, cut spending. It's set to increase spending by about $3.8 trillion in the next 10 years. We're already looking at a $37 trillion national deficit. So we're continuing to borrow money, much of which is borrowed from other countries, number one being Japan, number two being China. So we're very, very much dependent on foreign countries to carry this debt, which I think 13% of the money that we spend as a nation is going to interest on our national debt every year. So, which by the way is more than we spend on defense spending. So
sounds about right.
we have a major problem in this country with spending. And so the Republicans that voted against it are looking at it from that point of view. Democrats that voted against it think that it's too big of a tax cut. And, so it was very highly contested in the House. The Senate's looking at it now. They're making changes. We're going to go through this. There's some things that I talked about on the last episode that we talked about it that I feel like I was excited about, that once we kind of pulled back some layers, I'm like, that's not as good as I thought it was. Maybe it's not quite as beautiful as it's being sold to be, but we're going to go through it, and you be the judge. But
don't take my word for it. I think taxes is a scam all the way across the board.
Yeah, well, what's the two things that are certain in life?
Death and taxes.
Death and taxes, buddy.
Yeah.
So,
that's one of the things I was explaining. We were just talking about this, me and Sarah, and I said, do you realize, like, every payday, the person that makes the most out of our whole company is the federal government? You know what I mean? Like, when you sit down and look at it, you're like, and like people that have always worked for a job, they don't get that at all,
Yeah.
So
yeah, it's we pay a lot of money in taxes between federal and Social Security and Medicare and unemployment, state.
Yeah, a regular
gas.
9 to 5 employee has no clue.
It's hard to judge because you get your net. When you own a business and you have to pay it at the end of the year, you get a whole different concept, you see it from a whole different angle, and it gives you a different perspective on the amount of money you pay in taxes, and it's
right. I mean, like, if you have a big thing going on, like in my business, like, yeah, you're cleaning a ton of clothes, but there's a water bill next month is going to be triple.
Yeah, if you when you look at it from a business owner point of view, and you start to realize that the first 4 or 5 months of the year you're working just to cover the taxes,
right?
It becomes a hard pill to swallow.
Yeah. Well, it's one of those things,
Yeah.
Death and taxes, and
yeah.
I don't know. There's no quick answer, and I think that they thought this is going to be beautiful. This is going to be the answer, but it's turning out that
it may not be as great as everybody thinks. So we'll just start with some of the basic stuff. The standard deduction for now, this is what's been proposed, okay. Right? So for the majority of this, we're talking about what is being proposed by the House of Representatives, unless I specify that it's for the Senate. So this is big, beautiful bill for the House of Representatives. So the standard deduction is going to go up, and for 2025 to 2028, they're going to bump it up $1,000 for single people, $2,000 for married people. As of 2029, it'll drop back down. But for 2025 to 2028, if you're single, it's going to be $16,000. Head of household will be $24,000, $32,000 for married filing joint. It'll go down $1,000 and $2,000 respectively. And then if you're 65 or over, it's going to be $4,000 more than that for each of those.
So like a single 65-year-old will be able to take $20,000
as a standard deduction. So those are all going up over from what they are now. Now, if you noticed, I said 2025, not 2026. So a lot of these changes, they're actually making retroactive to January 1st, 2025, okay. Which some of these things, it's not that big of a deal. Some of these things, however, are going to pose some complications, and we're going to kind of go into that. But a lot of this big, beautiful bill, most of it, actually, they're actually going to try to start retroactive to January 1st of 2025.
So the simpleton in the room, I want to know why at 65 you get more of a write-off.
Well,
because they're not making as much,
so a lot of this, they've always done a higher standard deduction once you hit 65. It's always been a thing. Some of this is, and we're going to talk about it more, I have some notes on there. You remember they talked so much about no tax on Social Security, right?
Right.
Yeah, that went away. I think they realized that we can't afford that, so that disappeared.
Yeah, you can't sustain it.
Right. So there's some perks in here for 65-year-olds and older to try to throw them a bone, because we're still going to tax you on your Social Security.
Right, and they don't have any dependents at that age. Typically at 65, your kids have all hit the
But if you think about it,
out phase.
If you're married filing joint and you're over 65, you're getting $40,000. You're getting tax-free. So you can make $40,000 a year
on Social Security
and not pay any taxes.
Hate it.
So you're still, that's pretty good benefit. So that's part of it.
Wait a second, but the Social Security is being taxed.
So Social Security is only taxable. Social Security, if all your income is Social Security, it is not taxable.
Okay.
Social Security only becomes taxable if you have other income. Now, and it's based on a extremely complicated calculation, and that's always been my argument about it, is that not necessarily that it's taxable, but is that it's too complicated. My argument with Social Security is that I don't have a problem with it being taxable. I think that it should be 50% taxable or 0% taxable. My problem is that when you hit a certain amount of other income, it goes up to 85% taxable. I think that extra 35% between 50 and 85, I think that's where your bullshit is, because if you think about it, you hear people say all the time, well, I already pay taxes on my Social Security. Well, technically you pay taxes on half of it, because you pay taxes on your share of what you paid into Social Security, but you didn't pay taxes on what your employer paid in.
Right.
Your employer has always matched your Social Security. Yeah. Okay, so you've always gotten half of your Social Security tax-free. So my thought of it always has been that you should be getting, if you don't have any other income, I don't have a problem with it being tax-free. If you have other income, it should cap out at 50% taxable, in my opinion. And if you want to have a scale, it should be something simple where once you hit a certain amount, it's taxable. It should be something more simple. Right now, it's a very complicated scale. And what ends up happening is, and I see it time and time again, where I'll have a client that lives, well below their means. They have a retirement account, but they don't really do much with it. They take maybe the required minimum distribution. They live on very little of it. They stay well under the threshold where their Social Security is not taxable, or it's very little of it's taxable, and they pay no taxes or very little taxes, right? And they never owe any money, or they owe very little, right? And they just do that every year. And then here comes a situation where they decide they want to buy a car, right? So they think to themselves, well, I'm going to go buy a car. I'm going to buy this car. It's $30,000. Okay. Well, I know I can either go out to the car, I can go to the dealership and I can borrow $30,000, but I don't want to pay interest. I have all this money in my retirement account. But if I pull $30,000 out of my retirement account, Jerry's going to be mad at me because I didn't pay any taxes.
Right.
So I'm going to take $36,000 out of my retirement account. I'm going to have them withhold $6,000. So Jerry will be happy because I'm going to withhold 20%. So I'm going to take $36,000 out of my retirement account, pay $6,000 in taxes. I'm going to buy this car. I'm going to pay cash. Well, what you did was you added $36,000 to your taxable income. But you didn't just add $36,000 to your taxable income, because you also made your Social Security taxable at 85%. So you may have added $50,000, $60,000, $70,000 worth of taxable income. So now on top of this $6,000 you had withheld, you may owe another $4,000.
Isn't that where the Pennsylvania lottery kicks in? They take care of the senior citizens?
No, that's a whole different program. But so I can tell you it happens a couple times a year where I'll have a client come in, they think they did the right thing. They come in, they owe $4,000 in taxes. And they're like, what do you mean? I thought I was doing the right thing. And really, they should have just went out and bought the car and financed it because it would have been cheaper. And then what they could have done,
Wrote the car off.
they could have taken the payment out of the retirement account a month at a time over a 5-year period.
Yeah.
Because that amount broken up over 5 years maybe would have kept them under that amount and they would have paid less taxes. So
I think
a call to their accountant during the year could have saved them money in taxes. But that complicated scale of their Social Security creates that problem. That's always been my beef with the Social Security, how it's taxed. Not necessarily that it's taxable, it's just how it's done. It's complicated, it confuses people, it's stupid. So anyway, it's a long story short, Social Security is still taxable. They're not changing shit with how Social Security is taxed, but that's what that $4,000 is. There's another little perk in here we'll talk about later. They're basically just throwing seniors a bone because we campaigned on it being tax-free and we didn't actually deliver, but here's a little something so you're not pissed off at us. But that's
common sense would say there should be a max tax in this country. Like,
that would never happen.
Like at some point, you're 73 years old and you've paid, $4 million in taxes in your life. You're off the hook. Mm-hmm. Forget about my Social Security number, just get rid of me. I'm good. Yep. But that's too easy, Yep.
All right, so
they're going to tax the tips then. Is that the next one you're going to tell me?
No, it's not the next one. We're going to get to that. The auto loan interest, okay?
So the American-made vehicles.
On American-made vehicles. So just to recap, we talked about this a couple weeks ago. They're going to allow an above-the-line deduction, which means it's on the first page. You don't need to itemize. On the interest amount on a vehicle loan if it was built or assembled in the United States. Now, there hasn't been any guidance on how an accountant is supposed to determine whether a vehicle qualifies. I assume it's going to be based on the VIN number. Typically, if the VIN number starts with a 1, it was built in the United States. They haven't really given us any guidance on that, but that's what I'm assuming. The details of that, the deduction is limited to $10,000 per year. There are phase outs. So if you're single, they start to phase that out if your income is over $100,000. And for every dollar over $100,000, you lose 20% of that deduction. If you're married filing joint, the phase out begins at $200,000. Any vehicle that is usable on public roads qualifies, so cars, vans, pickups, whatever. Another little weird thing, according to the Big Beautiful Bill, ATVs qualify as long as they're legal on public road. And campers and trailers are also...
a golf cart with lights.
Yeah, a quad if it has a plate on it, dirt bikes if it has plates on it, those qualify.
You got to get those rural votes, you know what I mean?
Yep. Campers, trailers, they also qualify. So those are good. Cannot be used. No fleet vehicles. You cannot refinance a car that you already own. No leased vehicles. You have to buy it outright. And you can't take out a loan to buy a car. You can't use a loan on a car that you bought for scraps or parts. That they specified that in there. I don't know.
That's that rural thing.
Yeah, fucking goofy. I don't know why you would do that. I don't know what bank would give you a loan to buy a car for scrap, but sure. So I think those phase out points are gonna hurt some people. I think that I've had some conversations with some clients that are kind of excited about this, and then once those phase out points were published, I was like, oh yeah, you don't qualify, but you make too much money, you're out. But
hey, they're just trying to help the wealthy.
Right. Yeah, it's only the rich. So that's the details on the auto loan deduction. Stay tuned for more details on what actually qualifies. The big question is going to be, and as time goes on, you know, I know that there's going to be some confusion on, you know, like I drive a Silverado, Chevy Silverado, so that would all be, it's an American truck.
Yeah.
Well, mine was built in Canada. So
what's the stipulation for fleet vehicle? What are they considering a fleet vehicle?
yeah, there's no real stipulation to that yet. So I don't know, because like when I owned the property management company, we bought a base model Chevy Trax that is a very popular fleet vehicle. Now, it was in a company name and it was a company vehicle, so it didn't qualify anyway. It was a company car and we wrote off the interest anyway. But would that be a fleet vehicle? I mean, it was a white base model Trax. Like,
yeah.
But, so I don't really know.
Yeah, you wonder if they're just going after like a company.
And most fleet vehicles are purchased by a company, so I don't really know.
Yeah.
It's weird because a company is going to write that interest off anyway on a business return,
right.
So it's already deductible. I don't know.
Yeah, there was some kind of dig there. They had to crawl in the ass like Hertz or somebody was doing something shady.
Yeah, I don't know.
Like, yeah, we're gonna make sure you don't fucking qualify for this.
I don't really know.
It's a shame. I mean,
the vehicle has to be purchased after January 2025. It can't be a vehicle purchased before, which is another stipulation that we talked about last time. So it can't be something that you already own. You have to, so that's gonna. That's liable to spur some.
I don't follow the tax code obviously like you. I don't need to because I have you. But I always, when I hear this news, I always like think of like, who are they trying to hurt and who are they trying to benefit?
Right.
Because they're not doing this because they want to figure it out for you and I and people that are buying cars. It's like there's one particular party that they're trying to fuck over, and there's another party where they're trying to hook them up.
We've talked about that before. They use the code to manipulate.
So these 65-year-olds that are out there buying fleet cars, they're hooked up.
Yeah, I don't know. Are they trying to avoid? Yeah, I don't know.
Yeah, that'll be for election time.
And there was also, the original bill said that it had to be a new vehicle, and the National Association of Dealerships, or an organization that works with car dealerships, is petitioning Congress to try to include used vehicles. So that's still being debated right now.
That's so funny because every industry has a lobbyist.
Has that lobbyist.
Yeah, so like, you know, when they're doing these tariffs, like they raised our, I'm a member of like the dry cleaning like association, the PDCA before, now DLI, but they're like sending us letters like, we're fighting for you for these tariffs. Like, so they're pretty much justifying their $99 a month.
Right.
Like, and they send people to Harrisburg to be like, well, what about?
Yeah.
Thank you for listening. And now a brief word from our sponsor. You've got a full plate. Kids, meetings, workouts, side hustles. There's better things to do than laundry. Introducing Wash, laundry reimagined for the modern world. Schedule your pickup in seconds via the convenient web app. Wash picks up your clothes, cleans with care, and brings them back fresh and ready to wear. But it's more than garments. From bedding and table linens to shoes, hats, purses, and more. Wash handles all your life's fabric, leaving you more time to do you. Visit pickupwashdeliver.com and see how convenient it can be to do the wash. And now, back to the show.
All right, next, child tax credit. If you got kids, this applies to you. From 2025 to 2028.
But they have to be made in America, right?
Yeah, made in America. Your child tax credit will go from $2,000 to $2,500. In 2029, it goes back to $2,000 unless they extend it, which they probably will because no politician wants to be there when it goes back. The other dependent credit, which means, your aunt that lives with you or your parent that lives with you that's not working, whatever, that's staying at $500. And it will be made permanent because that was something that was enacted with the Tax Cuts and Jobs Act. The Big Beautiful Bill makes that a permanent.
Wait a second, rewind. So if you move your mother-in-law in with you, right?
You get a $500.
Unfortunately, in your circumstance, it's not possible. And in my circumstance, it's not possible. I mean, I'm just never going to let that happen. But I can figure out a better way to make a $500 tax cut.
Yeah. Yeah, $500.
Yeah, I'll fold 10 $100 bills in half and put them in a piggy bank before I get that tax credit.
Yeah. Another thing to mention that was made permanent that will be made permanent if this passes. So one of the things that the Tax Cuts and Jobs Act eliminated was the ability to write off moving expenses. So pre-2018 and 2017 and prior, you used to be able to write off moving expenses if you had to be relocated for your job. Now, it was put on your Schedule A. It was subject to a 2% floor, blah, blah, blah. But you could write off relocation expenses. Your Tax Cuts and Jobs Act made it so that the only people that could write off moving expenses were active duty military, armed forces, and it had to be a permanent relocation, duty station relocation. The Big Beautiful Bill makes that a permanent change.
For the military.
Just military. So that will stay. It's considered a permanent tax change. Now, when I say permanent, it's permanent until another next Congress votes to change it again.
Right.
Right. So, all right. Another change with Tax Cuts and Jobs Act that was highly contested, and it has been discussed a lot since 2018, and nobody's made the change. Well, on your Schedule A, your itemized deductions, you've always been able to write off your state and local taxes. Okay, it's called your SALT deduction, state and local tax deduction. Okay, so that includes your state and local income taxes, your real estate taxes, etc. The Tax Cuts and Jobs Act limits that deduction to $10,000. The Big Beautiful Bill increases that limit to $40,000.
Which is right in line, probably.
So they've been talking about trying to increase that since 2018 because the Congress people, the representatives and the senators from states like New York and California, the states that have high tax rates, their constituents are pissed because it doesn't take much to exceed $10,000 in those states. Here in Pennsylvania, it doesn't take much to exceed $10,000. It's not, you don't have to be wealthy, especially Allegheny County. It doesn't take much to exceed $10,000 between property taxes and state taxes and local taxes in this area. So constituents and politicians in these areas have been trying to lobby for that to be increased for several years. The Big Beautiful Bill increases that to $40,000. Now, with that being said, the proposal that was just put up in front by the Senate puts it back down to 10. So, Senate's trying to say 10, the House of Representatives are trying to say 40.
They'll meet in the middle.
I'm thinking they're probably going to meet in the middle. I would expect this to be in the $20,000, $25,000, $30,000 range. I don't expect it to be 10. I don't expect it to be 40. It's going to be more than it's going to be somewhere in the middle of that.
How hard is it for them to pull a national average?
I don't know. And 10 might be enough, but I can tell you with a $10,000 limit in Pennsylvania, that
in Allegheny County, that puts you in a $200,000 house.
Right
there. School taxes, property tax,
and then in order to be able to afford a $200,000 house with your income taxes that you're paying to the state and to your locals, you're over $10,000.
100%.
So yeah, absolutely. And I think because of that limitation, it's making it so that more and more people can't itemize on their tax return.
Which makes sense.
I think that is ultimately the goal.
Right.
I think that the IRS and the Department of Treasury is trying to eventually eliminate itemized deductions.
Yeah, get people to just throw their hands up.
Give everybody a standard deduction. Just make it across the board.
It makes
standard.
sense.
Yeah.
I mean,
but that's, in my opinion, going to have a negative impact on charitable organizations because, unfortunately, there's people that look at that like, I'm not going to bother donating to charity. I don't even get any benefit out of it.
Right.
Which is nonsense. I mean, you should be donating to charity for the wholesome
kindness
feeling, the kindness, the fact that they need it. But if you don't get a tax benefit out of it, there are people out there that don't do it because of the lack of tax benefit.
Yeah, I kind of think if they want to go that route, then maybe they would just come up with a number based on your so we're in 2025, based on your 2024 income, here's your projected tax. If you pay it all right now, it's like a workman's comp policy. You get a 10% discount if you pay up front, like your insurance policy.
Right.
So I don't know. I'm just talking there, but like it doesn't seem like this is so beautiful for the normal person.
The big beautiful bill?
Yeah.
Oh yeah.
What's the next one, buddy?
No tax on tips.
We tax and tips? Yeah. The first $500 is tax free.
So it depends on which side whether you're looking at the House or the Senate. So I have some details from both proposals. The big beautiful bill from the House is better than what's the Senate, but they're both a little bit fuzzy. So according to the big beautiful bill, again, this is an above the line deduction. There's still not a lot of guidance on how this is going to be reported. Here's the bright side of this is that tips are already reported separately on a W-2. So there's not going to be that big of an administrative change on how your pay is reported. It's an above the line deduction. The fortunate thing of it is that your taxes, there's not going to be a huge administrative change to this because your tips are already reported separately on your W-2. There's already a line for Social Security tips. So they're already being reported separately. How they're being taxed is how it's going to be changed. The big beautiful bill definitely is more beneficial to the taxpayer. According to the big beautiful bill, there's going to be a list of qualified occupations. So it's going to be your restaurant employees. It's going to be your hair salon, barbershop employees. It's going to be occupations that are typical tip receiving.
So you're not going to be able to be an engineer.
Correct. It's not going to be professional service companies. It's not going to be, things like that. It's going to be a lot more difficult than I think some people were hoping to be able to flim-flam the system to be like, well, I'm just going to work for tips now. It's not going to be that easy. There appears to be a phase-out point that at $160,000. The bill that was presented doesn't really specify whether that $160,000 is for married filing joint or married filing separate.
So you have to make $160,000 in tips before it's taxed.
Total income.
Okay.
We think. But that's the question. So they didn't really specify.
People will just report that they made $100,000.
But that's the thing is it's credit card tips get reported.
Yeah.
So it's not really up to them. So, but then if your husband or your wife works and makes $200,000 a year, and this is $160,000 married filing joint, does that mean now you have to pay taxes on your tips? There's not a whole lot of guidance here. That's where things are going to start getting a little bit sticky. So we're waiting on a little bit of guidance. I think that there's going to be, I don't know that this is as great as what everybody thinks, where it's just going to be this blanket
it was a
tips are tax free now.
It was a hoorah for like the working class.
The Senate one is even worse. So the Senate just gives you your first $25,000 worth of tips are tax free. Everything above $25,000 is taxable. So your bartenders and servers that are working at a restaurant that, I know of bartenders and servers that are making six figures, they're paying money, they're paying on those tips. So they also have a threshold of the $160,000 phase out. So the other
your
thing,
wife, say your husband's a bartender, he makes $40,000, and your wife is a attorney, she makes $190,000.
Yeah, you might be paying taxes on all your tips.
You're getting whacked.
Yeah, and both of them seem to only be giving you this tax break on your federal withholding. Neither one of them seem to be giving you any break on Social Security and Medicare. which we also pretty much expected because Social Security is broke. Medicare is one of the leading budget items on the federal budget. I don't see them giving you a break on Medicare. So I don't think they're going to be giving you any sort of discount on FICA. So neither one of them are as good as what was really campaigned on, what's really been sold on the media. But, I mean, there is some relief there as long as you're not married to somebody that's making a ton of money, or as long as you're not working for a company or working for a restaurant or bar and you're not making a crazy amount of tips. There is some benefit, but it's probably not what most of the people that are receiving tips are expecting it to be. Now, there's a lot of people that are not real happy about this. And one of the instructor that was teaching this, he had an example of why this is being so heavily contested and why maybe we need to rethink this. Think about this, and this is an example he used, and it's something that you kind of have to go, yeah, he might have a point here. If you've got two people, both of them make $30,000, okay? And one's a bartender, and he makes $5,000 in an hourly rate, and he makes $25,000 in tips. So he makes $30,000. And the other one makes $15 an hour at McDonald's. He makes $30,000 a year. Why does the guy at McDonald's have to pay more taxes than the bartender that's making the exact same amount of money? It's a benefit, not quite the benefit everybody's looking for.
Yeah, because at first glance, you're like, oh, we're just tipping everybody.
Yeah. I think the biggest disappointment of all of it is the no tax on overtime.
They got rid of that?
They didn't get rid of it. It's just not what everybody thinks it is. So it's also going to be a logistical nightmare. So let's start with why it's not what everybody thinks it is. So when I say no tax on overtime, if you're working overtime hours and you worked 45 hours last week, so 40 hours at straight time, 5 hours at time and a half, I'm sure that you would assume that your no tax portion of that would be on the 5 hours of time and a half.
Right.
So you would assume that your no tax portion would be on the 5 hours at time and a half. It's not. Your no tax portion is on the half. So 5 hours times 0.5. So the logistical problem of it is these payroll companies.
Software is not prepared for that.
Right. So the bucket that everybody's overtime isn't necessarily set up for time 1.5. It's 1.5. So now you have to do the math. And not everybody gets just time and time and a half. Sometimes overtime is 1.5. Sometimes it's double time. Sometimes it's double time and a half. Sometimes it's triple time. So now you've got to figure out what's the premium pay that is supposed to be tax-free. And now to add insult to injury, this is supposed to be retro to January 1st, 2025. So now I own a payroll company.
It's fuckery.
I've got to go back and figure out everybody's overtime to figure out what portion of everybody's pay is supposed to be tax-free from January 1st of 2025
until
forward.
They figure this out.
And this may not pass
until October.
I mean, it could be November.
Yeah.
And if I wait, I could literally have a month to figure out all these people's overtime in order to start getting W-2s out that are going to be brand new, because they're going to have a line item on the W-2 to show how much of the money is overtime pay.
Yeah, there's no quick answer. Like, they can't say your first $10,000 of overtime is tax-free, because then you have people, because we all have that employee that knows their numbers down to a science, and they're just done working for you after they made their 10 grand.
And I think right now, the problem is that employee that knows their hours down to the dollar is probably also assuming that their tax-free overtime is the time and a half, not the half.
Yeah.
So they're about to see that only a third of what they think is actually tax-free.
I mean, it's a big benefit to like where they tell
It's
you.
a benefit, but it's not nearly the benefit that they think it is.
Yeah, it's a cluster.
And then there's a phase-out point of $160,000. And they haven't specified. All it says is $160,000. So is that for a single person? Is that for married filing?
Well, that's a protection.
Married filing
so
joint?
People don't.
We don't know. So if you have, say, let's just use an example, okay? If I've got a union guy that, say I have a steam fitter, and he's working all kinds of overtime, but his wife's an attorney, he's not going to get any tax-free benefit on his. What if I have a police officer that works all kinds of overtime,
And he's not married.
but he's married, and his wife also works? He's not going to get any benefit on his overtime. That 160 is going to take this benefit away from a lot of people that that voted because of that campaign and are a big fan of this big beautiful bill because of that tax-free overtime, and it's all going to be gone because of a phase-out point that people aren't expecting, and because it's not on time and a half, it's on the half.
Yeah. I mean, it's a protection. It's simply, as I sit here and listen to a lot of this, these are all things that are put into place to make people want to report all their income and hide none of it
Yeah.
so they can see the whole snapshot.
Yeah, this is it's just another example of a benefit that has been promised and talked about and everybody's all excited about, but whenever the ink hit the paper, and let's not forget the big beautiful bill's 1,100 pages long.
Yeah.
So nobody, including the assholes that are voting on it, have actually read the fucking thing. This is what you end up with.
Right. I mean, it's smoke and mirrors for an election.
It's smoke and mirrors.
Yeah, it's a battle cry.
Yeah.
You know, if you had 300 guys and you're going to war against the 10,000 guys, the guy that's leading the ship doesn't stand up there and say, "We're all going to die. Who's coming with me?" You know?
I think that, So, couple other things. HSA, there's some changes to HSAs, allowing some.
For those of us that don't know what an HSA is.
Yeah, I'm sorry. It's a health savings account. HSAs are one of the things that I think a lot of people don't take advantage of. You can put money into a health savings account and deduct it off your tax return. The House bill, the big beautiful bill, is increasing the amount a single person and a married filing joint tax payer can put in per year. Basically, you're putting the money into a savings account that you're allowed to use for medical expenses during the year. You deduct the amount off your tax return, and then if you use it for qualified medical expenses, it's also tax-free. So think of it like if you're putting money into your retirement account, you get the deduction for it, and then as long as you keep for a retirement account, as long as the money stays in there till you're 59 and a half, you pay the tax when you take the money out. But with a health savings account, you take the deduction when you put the money in, and as long as you use the money for medical, you never pay taxes on it. So you kind of get the benefit twice.
Yeah.
You know, it's tax-free
It's
money.
health insurance without health insurance.
Right. So if you have say you have a health insurance with a high deductible, say you have a $6,000 deductible, you're kind of crazy not to put $6,000 into a health savings account every year, because you can use that $6,000 and get that off your taxes. Or if you have co-insurance, or if you have things that aren't covered, like prescriptions, or, you know, like I have a CPAP machine that they only cover like 50% or some bullshit. Like I could put money in there and use it for that. The another cool thing is they're allowing you to put up to $1,000. If you're married filing joint, you can spend $1,000 a year for gym membership. $500 if you're single. So there's
those lobbyists, man.
Yeah. So there's things like that you can use HSAs for. That's pre-tax money. So HSAs are one of those things that a lot of people don't even realize are out there that you can use. If you're the big beautiful bill lets you put, if you're single, $8,600 into an HSA, $17,100 if you're married filing joint. Again, there's phase outs. The phase outs start at $75,000 if you're single, $150 if you're married. So keep that in mind as well.
That's not a bad concept to people that are a healthy family that's never using healthcare either. You just put the money in.
Yeah, put the money in. You can carry it over. It doesn't just go away.
Yeah.
There are some rules, I think, on how much you're allowed to carry over. Read into that kind of stuff. But an HSA is a good vehicle. It's definitely something
I'd rather do that
you
with
can
my
use.
auto insurance.
Yeah, you can't do that.
That'd be an awesome plan. Put $15,000 in a year.
Yeah.
State honors it.
Yeah.
After 10 years, you wreck a vehicle, you have $150,000 to replace it.
Yeah. Couple other things to go over. So they did this a few years ago. Forget what year they did it. Charitable contributions are always something you can itemize on Schedule A. Like we said before, so there's not many people that are itemizing anymore. But on the Big Beautiful Bill, they're going to start allowing you to take a small charitable contribution on the first page so everybody can take it. It's small, and I have a feeling it's one of those things everybody's going to put on there. $150 if you're single, $300 if you're married filing joint. It's going on the first page of your return. So it's considered an above the line deduction. So everybody will qualify for it. The bonus depreciation is back. Back when the Tax Cuts and Jobs Act happened, they allowed a 100% bonus depreciation. So if for your business, you bought a car, you bought a piece of equipment, you did leasehold improvements or improvements on your building or things like that, anything less than a 20-year amortization or depreciation useful life, you could take all in 1 year, take 100% of it. And then the way it worked is after a certain year, I forget what year off the top of my head, it started to go down 20% every year. So it went from 100% to 80% to 60%. It expired, so it was going away for 2025. Big Beautiful Bill brings it back up to 100% starting January 19th, 2025. So any asset you bought from January 19th, the day before Inauguration Day, my friend. Yeah. So if you bought an asset any day after January 19th, 2025, if the Big Beautiful Bill passes, you will be able to take 100% bonus depreciation and write it all off in 1 year. So that is going back if this passes. What else is here?
Give us the fun stuff. Jet skis, write them off.
No jet ski write-offs.
Golf memberships, write them off.
The threshold for 1099Ks, that's a big hot topic. 1099Ks are the 1099s that you get for credit cards. Like if you accept credit cards like Venmo, all that kind of stuff, you'd get a 1099K. The threshold was $600 this year. It's going back up to $2,000. So that's less people are going to start getting those. A lot of people are all wound up about that. I'm going to skip a section because this is something I want to kind of dive into. I think it's a really cool thing that they're doing.
Is it the Corvette tax?
No, but we're going to skip over it and then just touch on a couple things and then we'll go back to it. Yeah. Real quick, the estate tax, the death tax is going to go up to the exemption for it. So right now it's like 13.99 million. It's like indexed for inflation. So if your net worth is less than 13.99 million as of this year, that's current bill. That's not the Big Beautiful Bill. If your net at worth is less than 13.99 million and you die, you are exempt from having to pay the federal estate tax. The Big Beautiful Bill passes, that goes up to 15 million. And then it's indexed for inflation. So as the years go on, that will go up and up and up.
Makes sense.
Yeah. So that's going up to 15 million if this passes. The qualified business income deduction was introduced with the Tax Cuts and Jobs Act. Basically, it was a 20% deduction off of your business income on your tax return. So if you're a Schedule C, an S Corp, partnership, if your net profit was $100,000, you could deduct $20,000 before you pay taxes. The big beautiful bill raises that to 23%. It also increases some of the phase outs. There were some phase outs. It increases them so that more people will benefit from it. The Senate proposal brings it back down to 20%. We'll see where they land. I think they'll probably end up keeping it at 20%. 20% is still pretty awesome. I mean, the fact that you can make $100K and then just wipe $20,000 off of it is still a pretty cool tax benefit to a business owner. So,
especially this podcast, all the money we're making here.
So, the qualified business income deduction is in the big beautiful bill, and it goes up to 23%. We'll see what ends up happening with that. One of the biggest things, we're going to go back up to this. One of the biggest things in the big beautiful bill that I think is actually a pretty big win. It's cool, and I think that I don't know. I'd like to see how it turns out.
Well, that's why you're not a politician. Because if you were, you'd say it's neat.
It's neat.
It's neat.
The Trump accounts.
Just like the Tesla's cute.
It's cute.
This is neat.
The Trump accounts.
Oh.
Okay. Have you heard about this?
No,
You know?
No.
Okay. So I'm going to tell you a little bit about it. Okay. If you have a baby from January 1st, 25 to January 1st, 2029.
I would consider myself out for that, but.
Me too. But the federal government will put $1,000
okay.
into an account for that child. Okay. The baby has to be a U.S. citizen, has to have a Social Security number.
And made in America.
It has to be made in America. The parent must also provide a Social Security number. The account is opened by the parent, but the child is the account is in the child's name. The child is the beneficiary. Okay. The money can't be touched until the child turns 18.
Okay.
Okay.
Does it collect interest?
Yes. And it grows tax-free. Like you don't pay any taxes as it grows throughout the years. Okay. It just grows in there. Now, a parent can contribute up to $5,000 per year. It is not a deductible contribution. It's like a Roth account. Think of it like a Roth contribution.
Right.
Okay. But any growth of that $5,000 is also tax-free growth. Okay. Inside it, not when you pull it, but like you're not going to get a 1099 every year for the growth. Okay. Now that $5,000 is going to be indexed for inflation. It's $5,000 in 2025. They're going to adjust that contribution limit every year. It's important to note, if you have a child already, you don't qualify for one of these accounts.
And you can't get in.
You can't even open one. So go fuck yourself. Okay. Me, I'm not, my kids are out. Like you already have a kid.
I'm over here like, nah, like we're out.
I think that this program, it's a pilot program. I think they're trying it out. I have a feeling, I mean, if it works, I think they'll probably open it up to other kids. But
welcome to our generation, brother.
It's a pilot. I think that, I don't know. I think that this is a good opportunity.
They've been doing these things with education.
Yeah. So once the kid turns 18, they can start to use it. Now, distributions from this account. There's two types of distributions. There's qualified distributions, and then there's any other distribution. If it's a qualified distribution, which means it's used to purchase a principal residence, start a job,
education,
or attend college, and then there's some other things that they're working on listing as there's going to be a full list. Any money that you take out other than the principal amount that you've put in, any gains, will be taxed as capital gains.
Okay.
So at the 15% or whatever based on other income. Any other distributions that you take out, like if you just take it out willy-nilly, like, oh, I just want my money out.
Buy a car.
Whatever.
Unless it's made in
bullshit. Then it's taxed as ordinary income. So you'll pay a higher tax rate. Okay. But nothing comes out of that account until that kid turns 18. You can't come out. Cannot touch it. Okay.
I like it.
It's
neat.
If the kid's born after 2029, they'll still be able to open an account. But as of right now, the government will not be contributing any money into the account.
Well, that is neat.
As time goes by, if this works, I think that it will be I think they'll probably extend it. I think they'll continue to do it. I don't know. I'm looking forward to seeing how this works. I'm going to discuss this with my clients this tax season. I'm looking forward to this with my clients with kids that have kids this year. Whenever you have the kid, okay, you have a baby in 2025, there's going to be more guidance. I'm kind of assuming and paraphrasing. So the idea of it right now is that you're going to open up an account. You're going to say, this is my Trump account. And they're going to say, okay, that's going to get funded the first $1,000 and then you can put $5,000 a year into it, whatever. If you don't open an account by the time you file your first tax return and claim the kid, the Treasury will open the account for you. One of the questions I have is, where are they going to open the account? They're not a bank. I don't know where they're going to open the account for you. So there's some questions still. The bill didn't really specify. So there's a lot of question marks around this, but this is going to be a cool program. We discussed during this class the overall cost of this, and it's in the billions, but when you look at the trillions of dollars that we spend, it's pretty small. And I think this is important to help set kids up the right way.
Yeah, this is like an even playing field kind of thing.
And the amount of money that these kids can earn off of that $1,000 at the very beginning, and parents that are responsible. I mean, I know parents right now that are setting up Roth accounts for their kids, and
kudos to them. I appreciate that. Like, that's something we talk about a lot. But like when you're in the thick of it, like we do everything we're doing in our business, it's like, that money's just not there.
Yeah.
So,
but I wanted to get some of this information out because there's a lot of misinformation going out, depending on, what side of the fence you are, what algorithm you're in, what channel you watch. And I wanted to kind of give the real nuts and bolts of what's actually in this bill, because I think a lot of it's misleading. But I just wanted to put the truth out there, let people know what's up.
I think it's very informative. I enjoy to hear it because you hear these things in bits and pieces.
Yeah.
Because the narrative is always being played out in the media.
Yeah.
So, I mean, to hear it you're hearing it from somebody that's teaching this, that's qualified, and you're obviously qualified, so that's all good shit. So, hopefully we get to air this and it's pretty accurate.
Yeah.
Hopefully, they don't just blow it up because.
Yeah, and then we'll have to do something else.
We'll talk about the ZR1X.
ZR1X. Yeah, next time.
Tax write-off. That bitch is going to be made in America.
Yeah.
Thanks, guys.
Thank you for listening to Between Two Bridges, a business-to-business podcast. Find and follow us on your preferred podcast streaming platform. Like and subscribe, and leave us a rating and review. You can join us socially on Facebook, Instagram, TikTok, and X. You can email the show at info@betweentwobridgespodcast.com. Until next time, make it till you rake it.
Thanks, guys.